So I'll just give a brief format of this show. So here we are just introducing the new fund manager, new products which are
Okay.
used for our clients, and I'll just introduce you about your experience and what the product is, and then I'll hand it over the mic to you so that you can explain the product which we are talking about. This product, uh,
Smart Alpha.
Smart Alpha, which is a quant-based category 3 app, right?
Correct.
So from how long it is, what is the potential, how does the strategy works, and what is the expected IRR, and from how long we are there in this system.
Sure.
Okay. Apart from that, I will take some few questions on this, and then the closing statement after that.
Perfect.
Okay. So I'll just start. Hello. Yeah. My name is Vijay Chilka, and this is our Ask the Expert show from Allport Funds. I'm a vice president with Allport Funds, and in this particular show, we will introduce new products which are available in the market, which has some competitive edge among the rest of the products. And one of the such product is Smart Alpha by Anshika Capital, and we have Mr. Himadri Roy. Yeah. So Himadri Roy sir, thanks for coming our show and explaining, to get the user tell about this product, what is new about this. Before that, I'll just introduce Himadri ji. Himadri ji has a 20 years of experience in equity research, and he has been in investment banking, data science, and machine learning. He blends the financial expertise with machine learning and build a systematic factor-based investment models. Previously, he was with HDFC Bank, founded Quantum Growth, a global predictive intelligence SaaS platform, and he held a role with Taurus Mutual Fund, Morgan Stanley, Dar Capital, and ILFS Investment. So it's very good to know from you, sir. You have a very good experience, and I think the quant-based investments are very small in India, as it's very niche. So a lot of our investors are looking out from a new product where they can give a better alpha. So wanted to know about this fund, and after that we will take some questions related to this fund. Yeah, what do you say?
Perfect. Thank you. So, very warm afternoon, everyone. Let me share my screen also, and then I will straight dive into the presentation itself.
Yeah,
My screen is visible, right?
yes, this is the
Wonderful. So, Vishal, again, thanks a lot for having me on your show, and thanks everyone for joining on this Monday afternoon. As the headline says, and I would actually echo that markets don't reward opinions, they reward systems. So still, if you are investing with opinion, then probably you are already far behind. Uh, Bit about myself. I've spent more than 20 years, last 20 years in fund management, investment banking, and more or less last 10 years in data science and building systems and policies. In my earlier avatar with HDFC Bank, I was handling their entire analytics division for the liability product, where I got that opportunity to marry between the financial theory with the machine learning and human psychology. Straightway diving into the core part of it. uh, I will start briefly from the 30,000 feet view, how quant investing was evolved. Then I'll talk a little bit about how globally quant has been, and then I'll talk about what is there in India, and then specifically I'll talk about the fund which we have launched very recently. Now, very broadly, quant investing was born roughly in the eras of 70s to 90s. So I have divided it in three time frames. Some people have done it four time frames by dividing between 2015, 20 and post 20. Okay, but roughly these are the three eras of quant investment. At the very beginning, okay, Ed Trop, he actually proved that market patterns are exploitable. And probably all of you know Jim Simmons is the kind of one of the most talked about quant uh, fund manager of the world. He did, he built Medallion, and it gave very good track record. Okay, and it broke all the known names in terms of the amount of returns which he has generated. That was the era of 70s to 90s. Then the era came of the factor investment. Precisely in 1993, Pharma Finch came with the three-factor model. That is the factor institutionalization. When Pharma French, AQR, Smart Beta, value, momentum, quality, low vol, all these things, came and get democratized. Now, systematic alpha became institutional standard that time, and it is a famous term of factors view, particularly by AQR. AQR is a large, institution which have done exceedingly well in, quantitative investing, and they actually said that majority of these, factors are actually noise rather than giving you a signal. And finally, post 2015, the machine learning and alternate data came in, where 2 sigma, D Shaw, NLP on earnings, satellite imagery, credit card transaction, a lot of volume data came in post 2015. Post 2015, why I'm saying post 2015, because the computational cost has gone down after 2012, when all this large machine learning and AI companies started providing you the infrastructure for doing a lot of these complicated or complex machine learning processes. So how now coming back to the how global quant landscape evolved. Global landscape evolved in particularly three part. One is from the price to multi-factor. So initially, the everybody started with the price factor. Price is the price momentum. We all know about momentum, but gradually it came from price momentum to multi-factor because of Pharma Finch, and gradually Jagdish, Titman, and Petrosky and everybody came in. Okay, where you actually combine momentum, value, quality, and sentiment to compound alpha. So uncorrelated, when you're looking at uncorrelated returns, it actually don't average out. It multiplies exponentially. Then came the alternative data revolution, where earnings revision, smart money for NLP sentiment, hedge fund proprietary 10 years ago is now table stake for systematic manager, which used to be a very proprietary, very systematic for only a few people, that is the hedge fund people, some 10, 15 years back. Now it is for everybody because of the computational power. And then the institutional shift to systematic. Globally, roughly around 30 to 35%. In US, it is borderline 40 to 45%, which is complete AUM is complete quantitative or systematic or rule based. Where in India, we are roughly around 5%, and come to that. So where we are today, in terms of the penetration, we are roughly around 5% today in India. So historically, if you go back, you see, I forget about US. You talk about the Taiwanese market, South Korean market. 20 years back, Taiwan was around 4.5%. South Korea was around roughly around hovering around 5%. Today, they are more than 20% in terms of the AUM, which is into systematic. So the direction is very much clear that India will eventually, next 5 years, I can't predict the timeline, but whether it's 5 years or 10 years, but this 5% will become 20-25% going forward for sure. And we're seeing it. I mean, in terms of the evolution of ETFs, the amount of ETFs which are getting, included in the ecosystem, you can actually see this is happening. This is live. This is no more a, theory or a paper theory. We have 500 plus stocks in the Nifty 500, okay, which is with sufficient data, sufficient depth, which was not there 20 years back. So market was not, having a lot of depth in the 20 years framework. But last 5 to 10 years, you will see that there is a lot of, depth, which is already there in the Nifty 500, and the behavioral efficiency, which is humongous in India. I mean, post 2020, after the COVID, boom, all this retail investors who came in into the market, they're bringing lot of inefficiencies, behavioral inefficiencies in the ecosystem, particularly in the mid and the small cap space. And our category 3 framework is very much mature. Earnings revisions data, institutional data flow, all the data flow is already available for top Nifty 500. So essentially where US was in 2002, we are probably there right now. So the first mover advantage is already there with us, but it will not stay open for a long time. Now coming back to our own fund, the 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 evolution of our fund, why we came up with this fund and what was the logic behind it. So when we went back, we find out, and you'll also see that, ask yourself that in an asset, what are the three broader variable which actually drives the asset price. If you look at it, one is of course valuation, number two is sentiment, and third one is liquidity. Okay, anything you talk about, it actually is a sub part of either of these three bucket. It will be either of the valuation or the sentiment or in the liquidity framework. Now, different things in the valuation, sentiment, and liquidity. In India, if you look at today, all the discretionary fund managers, majority of them, they are actually in the first column. That is the valuation part. Now, where in the valuation they're looking at the DCF, the earnings, the cash flow, the intrinsic value, the relative value like price to equity, FCF, EV/EBITDA, then the value plus price action, like where you don't fall in the value trap category. Majority of the model is missing the important two more pieces, that is the sentiment and the liquidity. Okay, some better ones are doing nowadays are using price extrapolation, that is the momentum and trend, but nobody is actually willing to look at or do the deep dive or the hard work to look at what is the analyst tracking, whether they are doing the NLP sentiment analysis. Okay, and the third one is liquidity. Almost nobody does that. Okay, nobody is looking at the whether there is a market regime. Majority of them say it's a noise, don't look at that, but they are a very important fundamental property of any asset price, that is the liquidity. Okay, so smart funny flows, market regime, ownership transitions, everything falls under the liquidity framework. We went back to the drawing board and we figured out that how can we create a model grounds up with the fundamental pharma French model intact, but which is workable in India. So we looked at last 20 years data, we worked on something, and I'll now explain how and what we have built and what is the result of that particular product. So this is Smart Alpha in a single slide. When we went back to the drawing board, we looked at different factors. Okay, one important thing in this chart actually shows you, and on the left hand side the calendar years, and on the top you will see the different factors, how they have performed in terms of absolute return for each year. So let's say if I start with year 2012, momentum has done exceedingly well out of all the factors. First two are Nifty 50 and 500, and you will see that equal weight they have done 7%, low vol has done 15%, momentum has done 30%. That is the first row I'm talking about. And then multi-factor has done 19%, quality has done 5%, and value is negative 4%, right? So one distinct thing is that none of these factors are consistent, and they're very volatile in their own lifetime itself. We try to figure out that how can we use this knowledge to create a multi-factor model which is suitable for Indian market. Then we came up with a 6 bucket model, which is the Smart Alpha model. And what it does is that it actually tries to capture all the factors within that 3 parameter, that is valuation, liquidity, and sentiment, and whether a particular ranking can be done. So what we have done is that we have created the 6 bucket factor. In the 6 bucket factor, we put each and every stock of Nifty 500, we rank them accordingly, and then finally a composite score or composite rank comes, and we pick the top 50 out of it and make a monthly portfolio. And after the end of the month, we churn them as per the ranking changes. So what are the six factors? One is price extrapolation. That is the most used, abused, and most high frequency data which you can get in India market. That is the price momentum and trend. Then comes the analyst tracking. Nobody has done. Some people have done it in terms of bits and pieces, but nobody has done the way we have done it. And I'll explain it what we have done. We rank all the analysts as per stocks. Like let's say Himadri is very good with IT sector as such, but he's particularly good with Wipro TCS, not very good with Infosys. So Himadri's rank will be on the higher side for Wipro and TCS. But let's say Vishal is very good with Infosys, so his rank will be higher in Infosys. Okay, so all these companies, Nifty 500, we have ranked the top three, analysts in that, and it changes accordingly depending upon their perfection of the EPS estimates. Okay, we have tracked them, we monitor them. Whenever there is a ranking coming in from any of these analysts, we rank those stocks on top of the other. Then we avoid the value trap. How do we avoid the value trap? Because value investing. We do have complete regard for value investing, but there is a landmine there which is called value trap. Okay, so we don't want to fall under value trap, and that's why you combined. We created one proprietary matrix which is called value plus momentum, and we create we that actually help us to avoid the value trap. Then the fundamental quality. My initial years of my life was spent in the fundamental analysis. I was a Taurus mutual fund, ILFS PMS, dark capital. So this fundamental quality is one of the basic cornerstone of our model, where we look at each and every company. Even we go into the subcategory. We don't paint everybody with same brush. Like let's say for example, a paint company in the manufacturing segment is treated completely different than a defense company in the manufacturing segment. Or let's say a company in the BFSI segment, the NBFCs are treated separately than the HFCs and the banks. So that way we created ranking. There are multiple, numerous multiple, factors which are there behind or under this particular fundamental quality bucket itself. Then the smart money flows. Smart money flows not only look at, because that's a very dated data, because you quarterly you get that data of the FI and the DII, but you every day you get the bulk and block deal data, right? Through that, we have created a list of influential investors in India whose activity in a particular Indian stock market has a price persistency. That means when an investor enters into a particular stock, the price actually tends to go up, and if he exits, it tends to go down. Statistically, we have proven that, and we have ranked those investors accordingly. So we also have ranking. Then comes the NLP sentiment and regime. Nobody in India has tried to do it. This is a grounds up factor which we have built up. This is what it does is, at the end of the day, each corporate action news, each news item is getting parts through a system called NLP, natural language processing, through which we are assigning a sentiment score for each and every company at the end of the day. And this is how we actually align with that three bucket which we initially talked of: sentiment, liquidity, and valuation. This is our smart alpha 6 bucket approach, and this is the result. And this is where I would like to take a little bit of time just to tell you that with this kind of rigorous thing, this is what we have achieved. Since September 2020, our CAGR is 47.71. Within that, I will come to the breakdown of last 1 year when the portfolio went live. We are roughly around 27% till date. Okay, after all this problem of Pakistan India war and then Iran and US war, we are still in a 1 year point to point return 27% today. Our sharp is 1.3, Sortino is 1.65, which gives you a reasonable amount of comfort that we are doing something right in the ecosystem. And why? Probably one of the reason which you must have now realized that we don't try to play God. Okay, we don't try to play God and try to predict the system. What we do is that we adapt, and we adapt very quickly. So that's why the result tells us a very neat and clean thing, that the process which we have, It's not a high frequency trading. It's not disregard for fundamental. Neither there is a black box. Everything is or audited. The only thing which is not there is human emotion in this. We have zero emotion in this. No manual intervention. The model works on its own. We all continuously monitor the model. If there is any breakdown, the results are in front of you. Now I'll come to why the alpha creation has become a very difficult job in India. Like 20 years back and today, what has drastically changed is now we have more than 17 crore of demat account. Every month there is upwards of 25,000 crore of SIP. That means every month one mid cap stock is getting added in the ecosystem. Okay, institutional AUM now it's more than 60%. Okay, so what is happening? What is happening is that a very good fund manager who used to be who used to have a good proprietary model 10 years back with a reasonable amount of laptop and all, he could have done wonders in 10 to 15 years back, because that time alpha was persistent for months. Now with this machine which can scale with speed and consistency and multidimensional, of course, which you have seen now, right? This time frame has cut down to a couple of days on. So that's why it's become a very well oiled machine, where alpha generation has become very difficult for everybody. And that's why you'll see that the alpha generation has gone down in last 15 years tremendously in India because of all these factors. And what is why smart alpha is the need of the hour? Because I think the discretionary alpha is crowded and behavioral inefficiency is at its high right now. Okay, the infrastructure is already there. I mean, SEBI has created all the required system, and that's why cat 3 AF are there, so that they can take long, short, market neutral, all kind of strategies can be worked out on that. And we have a first mover advantage, because as you can see, we're roughly around 5% today in terms of the total penetration. With this, I will leave it up to you. I'll open up the question answer session. And the point is that whether Quant works in India, the data, as you can see, it works. The question is whether you want to be in, or just want to be sitting on the sidelines and watch it how it evolves. Thank you. So I'm getting a couple of questions. So let me take one by one. The first one is, can you explain what factor is in quantitative investing and give 3 examples of factor commonly used to pick stocks? So the most common ones, and there are hundreds of, 50 years of academic research has been done in the factor investment. The most commonly used are momentum, value, low val. Okay, some people use a lot of other things, but momentum, value, and quality, these are the 3 things which generally people use. I hope that answers your question. Then another question, what is backtesting and why can a strategy that looks great in, that's a very good question. Now the question is, what is backtesting and why can a strategy that looks great in backtesting still lose money in the real trading? See, the flaw of backtesting is that if somebody who is not very good with system design and architecture, they have a problem of look ahead bias. Okay, just to give a small example of look ahead bias, everybody you will talk to, you'll see that everybody is doing the moving averages, right? The moving averages is fine, but the moment you don't shift that date for one day, because if you are calculating moving average for today, you're already assuming the closing price is there. So for the return to get validated, you need to shift the return for one day. Nobody does that in India. So if you are able to remove the look ahead biases, your back testing and your live testing would have a good amount of correlation. But at the same time, because markets is not exact science, there is a huge element of human psychology which is involved in that. Okay, that's why all the time the market regimes are not the same. Okay, so that's why you have to adapt when your system correlation breaks down. Okay, you have to adapt, you have to change the system accordingly. So that's why in many systems you will see that real trading and the backtest looks real difficult different in terms of the results. In our case, Thankfully, what we have achieved in the back test of last 10 5 6 years, which has been proven right in the real life also, because our product is live with prop money since March 2025, and we have made 27% of absolute return as we speak today, after all this volatility and everything accounting for. So
So I think you have made a lot of work in six framework, identify the right trend, and which no other, I think, companies do in machine learning.
I didn't get you. Can you come again, please?
Yeah, uh, yeah. So I meant to say the company has done a really good job in maintaining a six framework. Identifying the opportunity, chasing the momentum, analyzing the stocks, the analyst who has a higher predictability at a stock level, and also the buy-sell ratio of an individual investor, which has a huge impact on the stock prices. And so the fundamental, technical, growth potential, the volume, the emotional content, everything is taken care of.
Correct.
Right.
So we never wanted to, shall one of the thing which we never wanted to do, because complexity, complexity actually creates a lot of problem in your life. Sometimes it is not simplicity, because to build up this model from grounds up, it would take a lot of effort, time, and understanding of the domain. But at the same time, complexities are
Mm.
not necessarily which can get you the returns. It is just that how systematically you can harvest all the inefficiencies, okay, at the right moment or at the right time, and how can you adopt. That is what makes a lot of difference, and that is what we're trying to build in Smart Alpha, and probably in our other hopefully once this gets a good amount of track record in our other schemes also, we'll be doing that also, where we will not create something which is black box. We want to create something which can be auditable, okay, which we know that why it is happening, although we are not involved in day-to-day operation, okay, or the selection process, but we know why a particular stock has come out, or why a particular stock has entered into the ecosystem. Because simplicity, in my last 22 years, I know that if you are if you are piggybacking on simplicity, probably you will succeed some way or the other.
Yeah. So I just wanted to have a question on this. What set of clients should this product would be suitable? The person who is able to take the risk or with a conservative approach, can they go ahead with this kind of a product? Because it's involved in machine learning, we are not very sure about the volatility part of it. So I just wanted to have a more clarity on the what is the volatility of a portfolio level in a long run.
Understood. And that's why I actually focused on that Sortino ratio. So if you look at Sortino, we are doing exceedingly well of 1.65, and that is for real portfolio. Let's not talk about the back test, forget about the back test, because a lot of people have question on the back test. Since March 2025, the portfolio is live. There's a out of sample in a statistical framework, we call it out of sample testing. We have
Mm.
still done 1.65. 1.65 is the Sortino ratio, which actually gives it actually tells you that what is the downside risk of that particular portfolio, okay, and what is the kind of upside you are getting because of the downside. Of course, there will be drawdown in this kind of a portfolio, okay. There will be drawdown when, and I can talk about the real life example itself. Let's say during this Pakistan India skirmish, okay, our portfolio was live. We
Mm.
went down much below than the benchmark. Our benchmark is Nifty 500, but the moment it got resolved, we came out, significant alpha generation happened. So you can expect roughly around 300 bips alpha in this kind of a product, okay. But there will be drawdown, okay. Volatility will be in line with Nifty 500. So you can say that Nifty 500, again, because we are creating 300 to 400 bips of alpha, there will be little bit much of volatility, but the risk adjusted Sharp as well as the Sortino will always compensate for the additional volatility which we're taking. So any investors who is coming in, okay, he should have the appetite to see the drawdown of roughly around near around Nifty 500 drawdown. So if you look at historically, statistically, you have done that every year. And in fact, forget about me. Don't put my money in my fund. You can do this yourself. Every year, Nifty, benchmark Nifty gives you a 10 to 15% drawdown every year. So we have done that analysis that, let's say you are a very keen observer of drawdown. Okay, the moment you
mm,
see, let's say 13% drawdown has happened in Nifty, put your money as an SIP in that particular year in a bulk, and then look at 10 years horizon. You will beat the benchmark with a very big amount. So
mm,
those kind of drawdown will be there, and people need to be aware about that. So that's why I say that at least for 3 years you stay invested with a fund, then only you will be able to reap the entire benefit of the journey.
okay. Now, talking about the composition of the stocks which are invested through this model, so is it so majorly a large cap companies, mid cap, or a small cap, or it's like a flexi cap, or any benchmarking that has been set by the company to identify the liquidity of the stock? Because liquidity was also a crucial part in your framework. So just wanted to know that, because if you select, by the way, as any small cap company, there could be a liquidity issue. So how do you tackle that? And if you can throw some light on that.
Perfect. So in terms of liquidity, and first let me come to the composition part of it. In the
Yes.
back testing as well as in the current live portfolio, we actually compare ourselves with a flexi cap fund. So till now, like let's say this month's portfolio, okay, we are roughly around 50% large cap, 30% in small cap, 20% in mid cap. Okay, 2% here and there. And we have
Mm,
seen historically this is the pattern, and it's not that sometime it will be 100% small cap or 100% mid cap, because of the guardrails which we have given in the very initial stage itself. Our liquidity framework is very, very stringent. A lot of people will have volume, and this we also have a upside downside liquidity parameter. That means, just to tell you, I mean, probably you have not heard this in Indian parlance. Any stock which is there in the upper circuit or lower circuit during even the intraday, okay, for last 6 months will never get included in in our portfolio for 6 month period, for that period. So last 6 months that stock can never be in the upper circuit or the lower circuit. The minimum market cap which we have today is 11,000 crore. Okay, the weighted average of the market cap of our entire portfolio is,
If it's 11,000 crore, so I think small caps are out of question.
no, small
And
cap is there. So small cap is 30,000 crore. More than 30,000 to 60,000 is mid cap. 90,000, sorry. More than 90,000 is large cap.
mhm,
Correct. So in terms of the liquidity parameter, we have a very stringent liquidity parameter. Okay. We also see RPTs. We also see whether there is a pledge. Only 3 companies in our portfolio has promoter pledge. And that too, we have a particular parameter there also, that up to this, for this industry, will never include in that particular segmentation itself. So let's say
mm,
in an industry where we have seen historically a lot of pledges happen because of the capital intensity and all, we have given a leeway in that industry for the promoter pledges, but not in the other. Like let's say if FMCG company with a very high promoter pledge, it will not get included in our stock until portfolio, until unless the promoter pledge comes down. So you'll see only 3 stocks there are in our portfolio which has got a promoter pledge. We'll not see companies which has a lot of related party transaction in our system. We have those kind of because what we talked about is, under the hood there are numerous multiple parameters which are working. I don't want to make a complex statement that where people don't understand what we are doing, right? So that
mm.
complexity, we wanted to create something in front of investor, that what is the actual outcome of those complexity. So these are the kind of parameters which are already there while screening our stock, and that's why I said that we start with Nifty 500. After the initial screening, only 350 stocks get, on an average, we have seen between 340 to 362 stocks for last 1 year, which got actually the machine learning weightages. Rest of the stocks get kicked out at the very initial phase itself, because of this
Mm.
strong guardrails which we have developed over the years.
The filtration is pretty much stronger before
Very much strong.
you
You
to
want to,
finalize the universe of the stocks.
yeah, of course, because see, this is other people's money. Okay, I have to be very,
Yeah.
my fiduciary duty and everything has to be very, uh, ironclad, I must say.
Mm. Yeah. So now talking about now this is comes under category 3 app. So just wanted to have a, what is the minimum ticket size, and is there any kind of a lock-in period in this, or if it is, what is the minimum time frame? And
Okay,
also we'll talk about the taxation part of it.
perfect. So category taxation, let me first clear out that taxation is taxed on our company. So you don't have to, as an investor, you don't have to pay tax on anything. It will be net of tax to you. Now coming back to Cat 3, as SEBI advised, 1 crore at one go because we are open ended. We are so confident we kept it open ended and no lock in. For three
Okay.
months there is a 1%, I mean 1%, I think, if I'm not wrong, 1% is the exit charges for 3 months. That's it.
Mhm.
And in fact, if you want to pay that exit charge, you can take out the money. So we are quite confident, and that's why I kept it open ended. We kept it without lock in. Okay, but the ticket size is 1 crore.
Okay. From how long we have back tested this strategy?
So backtesting has been done in 2015. Okay, but I don't want to say this 2015 because data in India became much more, I would say, authentic post COVID. Okay, because
Hmm.
the amount of data which we use in the entire ecosystem, if you say that it comes post COVID, so that's why I always talk about September 2020. Okay, but the backtesting is done for mostly about from 2015, 2010 to be precise. But during that time, during 2010 to 2015, and so some data points were not gradually. So those are like kind of estimated data which we have done internally, creating more Monte Carlo simulations and all. So that's why I don't say that. But clear cut with all data from 2020.
Okay. Now, as it's a quant-based thing, so there is a high probability there will be frequent buying and selling, and which you will implement to for short-term taxes, and which there is an assumption if there is a lot of short-term taxes which tax at a 20%, the alpha would be reduced to a large extent because of the tax structure. So can you just throw on light what is the, and are we taking a stock for a long term, and what is the short-term transaction cost in the total portfolio, and what is that impact on the net earning on the portfolio?
Perfect. I'm glad you have brought it up because that's one of my
Uh,
most sorted question. I want people to ask me this question. See, the way we have designed the portfolio is a 50 stock equal weight portfolio. Okay, with the 2% weightages, so that the risk management is done at the very stock selection and the portfolio construction part of it. Now the beauty of it is that we gradually toyed with the idea that we have also looked at that from 2% we will let the winners write the theme itself, and we have a upper capping of 4%, that any stock which reaches 4% will trim them. So on a monthly scale, what is happening, and this is for last 1 year. Forget about the backtesting. We know that what is the kind of slippages are there. Okay, but for the last 1 year, I'll give you the actual expenses. What is happening because of this short term buys and sells, right? There are some gains, some losses. Okay, in a net, what we have seen, it's not effectively large in terms of number. Okay, on a if you say this absolute 27% which I talked about, roughly around 4 to 5%, 5% will go away.
hmm,
Because that's calculated because of the prop money. We know that 5% has been because of the slippages. So what we have calculated on that CAGR 47% which we said, okay,
hmm,
that actually translates into 41 to 42%.
okay. So 5 to 5.5% goes in the tax part,
Correct.
which anyway the company is paying because it's a cat 3 fund.
Correct. Coming back to your churning question, the churning is on monthly basis, so it's not a very high frequency churning. Okay, it will be a monthly churn, and we want to create a portfolio which will have a medium term kind of horizon. So when I'm looking at a stock for a portfolio construction, I'm looking at a 2 to 3 month horizon, next quarter times. That's it.
As you said in the previous answer, you hold 50 stocks, 2% for each stock, right? So uh, at any given point of time, there would be 50 stocks, or there could be kind of less also at certain
50.
time.
50.
At any point, it would be
Any
50 at
point in
least.
time, it will be 50 stocks.
But means when we are selecting a high technically sound stock, getting it a 4% gain would be easy, I think. So the churning at that particular stock, or trimming of that particular stock, will be very frequent in that way.
Not necessarily. What we have observed is that because of the 2% each, na, reaching 4% becomes little difficult, because by that time a lot of other stocks also come, in the top slot itself. So it is always a relative, right? So if only one particular stock out of 50, out of 40 50 stock on stock is going up to 4%, it's okay. But the rest of the 49 stocks, if they don't grow at all, then reaching 4% becomes very easy. Okay. What we have seen is that very easy in within 2 months framework is that roughly around reaching 3.5%, not more than that. Because by the time another stock in the portfolio also gains, because if you look at our churn
4% is at the portfolio level, or a stock level?
portfolio level, 4%
Four.
of the total portfolio, it will not go up behind below, I mean above 4%. So 2% is what we start with. Okay.
Hmm.
And it will not never go beyond 4%, because that will create a idiosyncratic risk in the ecosystem. That's why.
So whenever portfolio is up by 4%, you again recalculate and restructure the portfolio
Correct. Correct.
based on the standard framework. Okay. And
And
from how
individual
long?
stock weightages in the portfolio. This
Okay.
4% will be individual stock weightages in the portfolio.
Okay. And from how long this is actively?
This is active since March, 3rd of March 2025. And we recently, last January, we launched this fund. Okay. Because December last week, we got the SEBI approval after, our promoter also saw a lot of promising, numbers in there. So we got our, successful SEBI application approved in last week of December. And then mid of January, okay, we launched a fund, and which is currently under subscription.
Okay. So can you just tell me what is the last 1 month performance of this particular? Because
So
the war started at 28th of Feb, and PMS has shown on an average 10% correction in most of the PMS cases. So I just wanted to know, when we are using a quant-based model, what is the performance of that in a same given time frame?
So last 1 month, like let's say I can talk about last Friday. Till last Friday, we were, still better off than the market by 1.4%. Okay, drawdown. There was a negative return in last 1 month, but 1.4% we are better than Nifty 500 by 1.4%. So if I'm not wrong, I don't have the number, offhand with me, because I'm not keeping well. So I'm home. But what I can vividly remember, it is for last 1 month, markets were down by more than 7-8%, if I'm not wrong, right? After
Yeah.
this 3% or 2% up and all, so we are roughly around 1.5% better than that. So let's say, if it's 10%, we are 7.5%, 8.5% down.
Something is better than the other products.
Anytime. And we have seen that, many of the time the drawdowns are far better than the market. Many a times we are not doing that great with the drawdown, like it goes down, up and down. But when
Hmm.
we come up, so the idea is that, when the market survives, or when the market sees the, upturn, or that, the when the
Hmm.
cycle turns, our portfolio is doing exceedingly well.
Hmm. So it was a good insight from you about the product. I think our customers also came to know about this product, and I think that there are very few, or this is one of the fund-based investment in this particular category.
Thank you.
Uh, I think this will have a lot of traction in coming years. As you said, India is very niche in this, whereas the other developed market are at 30 to 35%. They have a weightage in the quant investing, whereas India is just less than 5% now. So there's a
Absolutely.
far uh, road ahead from here.
Correct.
And thanks for your valuable time and
Thank
addressing
you
our
for
query on that.
Thank you.
Thank you, sir.
Thanks
Thank
everyone for joining. Bye bye.
Bye.